everyone, welcome to the next episode of our Contra investing series where we look at businesses that are fundamentally solid but are going through a phase of disappointment. Either because growth has slowed, narratives have changed or market expectations have reset. In today's video, we'll discuss Tata Technologies. I clearly remember 2 years ago, during its IPO, Tata Technology was one of the most sought after companies in the market. And honestly, the excitement was understandable. This was the first Tata Group IPO in nearly 20 years after TCS. Plus, Tata Technologies business was super exciting due to its focus on ER&D in the auto sector. Everything investors wanted was packed into one story. And of course, we were in the middle of the massive bull run. All these factors resulted in over 69 times subscription for the IPO. As a result, its IPO that was priced at 500 rupee opened at 1200 and touched a high of 1400 on the listing day. But since then, the story has changed. Over the last 2 years, the stock has gone through more than 50% correction. So naturally, investors are confused. Was Tata Technologies just an IPO hype story? Is auto ER&D structurally slowing down? Has growth visibility permanently weakened? Or is it a simple case of expectation correcting after an overheated listing? What's also interesting is the shareholding pattern. Public holding in the company peaked out in March 24. Since then, it has been reducing. In fact, recently, even the total number of shareholders have reduced. Meanwhile, FIs are slowly increasing stake in the company. DI holding has not changed much, and promoters have kept their holding intact. So during this correction phase, smart money is slowly increasing allocation in the company. That's where in today's video, we'll put Tata Technology in our 4-step contra investing framework to understand if it qualifies as contra bet for 2026 or not. Alright, let's get started. So first question we ask is the business fundamentally strong? To answer this, we need to understand what Tata Technologies actually does beyond the IPO narrative. So Tata Technology is an engineering and R&D service company, primarily focused on auto sector that contributes more than 80% of its revenue. Then it also includes aerospace and industrial engineering. In simple terms, Tata Technologies work behind the scene with global OEMs when a product is being created. For example, in auto, when an OEM plans a new car platform, Tata Technologies get involved from the very beginning, helping in designing the vehicle architecture, chassis and body structure, powertrain layout like internal combustion engine, hybrid or EV, then the software hardware integration. As the design moves forward, they also work on simulation and virtual testing like crash test, durability, thermal behavior. All of this is done digitally before a physical prototype exists. Then optimization of weight, safety and cost. In EV programs specifically, the work can include battery pack design and validation, thermal management system, integration of electric motors and power electronics, and adapting existing platform to new EV architecture. Outside autos, in aerospace and industrial engineering, the work is similar in nature. Design and validation of aircraft components, structural analysis, manufacturing engineering, and lifecycle management of complex industrial products. So this is not a typical IT service or staff augmentation model. This is deep domain-specific engineering work where engineers are embedded into the client product cycle. Relationship lasts for years and switching vendors mid-cycle is difficult and risky. However, this business is cyclical. When auto companies slow down capex or delay the product launches or reschedule the EV timeline, ER&D spending gets delayed. That directly impacts growth visibility for companies like Tata Technologies. Just hold on to this, we will discuss it in detail shortly. Now when it comes to management quality, Tata Technologies being part of Tata Group needs no introduction. The Tata Group has a long-lasting reputation for strong corporate governance, clean track record, transparent disclosures and disciplined capital allocation. Over multiple decades, Tata Group companies have also created significant long-term wealth for the shareholders, not by chasing short-term narratives, but by focusing on sustainable business. That credibility automatically extends to Tata Technologies, and that itself should deserve a premium. Next, if you look at the balance sheet, it is clean, virtually no debt, strong cash flow and no working capital stress. Tata Technologies does not require heavy capital investment to grow, which provide downside protection during slow phases. So if we conclude, is Tata Technology a fundamentally strong business? Answer is yes. Next question we ask is, are the current issues temporary or permanent? So before deciding whether the issues are temporary or permanent, let's first understand why the stock has fallen so sharply in the first place. In my opinion, the biggest reason is expectation reset. Tata Technologies came to the market at a time when market sentiment was very strong. We were in the middle of a massive bull run. Plus, electric vehicles were the hot theme and ER&D was considered a very high growth area. It was clearly visible from Tata Tech profit growth that jumped 2.6 times between 2021 to 23 period. Plus, it was part of prestigious Tata Group. On top of that, at IPO price of 500 rupee, company's FY23 annualized P ratio was 29 times, which was extremely reasonable as compared to peers like KPIT or Tata Elxsi. So basically, all stars were aligned for Tata Tech IPO. Strong earning growth track record, massive liquidity due to bull run, high growth potential in ER&D space, part of Tata Group, and cherry on the top was reasonable valuation. As a result, IPO got subscribed by 69 times and on the listing day itself, stock that was priced at 500 rupee got listed at 1200. Basically, on the very first day, the stock delivered 140% return. It was almost like a jackpot for those who got the IPO allotment. However, due to this crazy listing, Tata Tech P ratio directly jumped from 29 times to 70 times. Obviously, those were not sustainable valuation. Here the big lesson is, no matter how great a business is, if you end up paying a very high valuation, you cannot make money for a very long period. And honestly speaking, there is no fixed rule for PE ratio. It is more of an art and it requires a good understanding of business model, market cycle, important KPIs you should understand, and of course tracking the business growth over the long period. Obviously, it's not easy for someone who has a job or business to track so many things very closely. That's where I try to add value, where I have an exclusive series for serious investors who really want to learn every aspect of investing. Here I track nearly 200 companies and also share my own investment thesis, why I'm buying a stock or selling a stock. The goal is to empower you with the right knowledge so that you can invest with conviction. For more details, you can explore my website or join button of this YouTube channel. Also for the website, there's an additional 15% discount on this new year, but only for limited slot. Promo code I'll provide in the pinned comment. Friends, in the last 15-16 months of market correction and consolidation, it has resulted in very good opportunities in the market. So if you have been waiting to invest in your knowledge, this phase of market might be the right time. Okay, moving on, at a P ratio of 70-80 times post-listing, market was expecting 25 to 30% sustainable growth in Tata Tech earning. However, Tata Tech revenue and earning growth has remained flat since 2024. Obviously, when the market is valuing a company at P of 70-80 times and the earning growth is zero for last 2-3 years, valuations cannot sustain. So that resulted in profit booking. And it's been 2 years since then, its share price has corrected more than 50%. Now the confusion is, Tata Technology was supposed to be a high growth sector. Why has its earnings remained flattish since 2024? The big factor is slowdown in ER&D spending by global auto OEMs. Globally, auto companies invested heavily, assuming fast EV adoption. But the demand did not ramp up at the pace that was initially expected. Charging infrastructure gap, high battery cost, and affordability issues that slowed the adoption. As a result, many OEMs paused or stretched their EV program timeline. And when EV timelines stretch, engineering spend also gets delayed. Please note that it does not mean projects are cancelled. It just means execution is slower, which directly shows up in revenue growth moderation. Second factor was macro uncertainty. Last couple of years have been extremely volatile from macroeconomic point of view. Higher interest rate globally, geopolitical risk, and uncertain consumer demand made OEMs more conservative. In such phases, management focus shift from growth to cash preservation. Engineering programs that are not immediately revenue linked, they tend to move slower. Then third factor was profitability pressure in the core ICE business. So ICE, that is internal combustion vehicles, still contribute the most in industry's cash flow. Over the last couple of years, higher input cost, regulatory compliance cost, and the pricing pressure has squeezed their margin. And when core profit comes under pressure, OEMs become cautious on discretionary spending. And ER&D is one of the largest controllable cost heads. Fourth factor was limited diversification outside the auto segment that acted as a drag on the earning stability. Tata Technology is heavily exposed to auto sector where more than 80% of its revenue comes from it. Within auto, its top 5 clients contribute nearly 60% of its business, and Tata Motor itself contribute 1/3 of its revenue. So earlier during 2020 to 23 phase, Tata Tech earnings got amplified also because of the upcycle in the Tata Motor business. Aerospace and industrial segment are still relatively smaller in revenue contribution. That means earnings are still largely based on auto capex cycle. Whenever auto slows, Tata Technology feels it more sharply than more diversified ER&D companies would. For example, Tata Elxsi. So the key takeaway is ER&D spending did not collapse. It temporarily slowed down. OEMs focused on must-have projects and delayed nice-to-have ones. And since Tata Technology is deeply linked to OEM product cycles, that slowdown directly impacted the revenue and earning growth. Which is why the slowdown looks cyclical and macro-driven, not structural. However, the cyclicity in auto sector is one key risk that you should keep in mind before investing in Tata Tech. Now the next question is, what about the long-term demand for Tata Technology? Let's discuss that. Now let's look at the big picture. Is the long-term demand story still there or has something changed structurally? The answer is simple. The long-term demand story is still very much intact. It's because Tata Technologies operate in engineering and R&D service, and that is tied to product development cycle, especially in the auto sector. So over the next decade, vehicles are going through one of the biggest transitions in history. Electrification, software-defined platforms, connected system, ADAS, and safety requirement and emission norms. All this makes automobile more complex, not simpler. More complexity means more engineering work, not less. Even if some spend gets deferred in the cycle, the overall pie of engineering work is expanding over time because EV technology is still evolving. There is no single standard yet. Software and electronics have become the big part of vehicle architecture. OEMs cannot build all this deep engineering expertise in-house. They outsource it. And this is not just limited to Tata Motors or Indian market. Tata Tech works with global OEMs and Western auto companies are increasingly outsourcing this engineering work because it is more cost efficient and flexible for them. Outside of autos, there is diversification as well, like aerospace, industrial product, and other capital-intensive sectors where specialized engineering skills are required. So while the short-term growth can slow because of the cycle, the structural demand drivers like increasing product complexity, long development timelines, and outsourcing, they have not gone away. If anything, it's slowly strengthening. That's why from long-term investment perspective, the demand story is still intact. It's not broken, not capped. It's just that is normalized because of the high growth expectation. Now let's look at the fourth point of Contra investing framework. The fourth question we ask is, has the valuation reset? So after almost 2 years of correction, Tata Technology valuations have definitely cooled off. This stock now trades at around 37 times PE ratio and roughly around 5 times price to sale and about 24 times EV to EBITDA. These numbers are far lower than what investors were willing to pay during the IPO hype phase. But the real question at this stage is not whether valuations have corrected. The real question is whether earnings have delivered or not. And frankly, that's where the disappointment lies. Earning growth over the last few quarters have been very weak, especially for a company that was expected to compound at much faster pace. So even though valuations look more reasonable today, I would not call the stock cheap yet because valuation comfort only comes when the growth visibility improves. From here, everything would boil down to one thing. When does earning growth come back on track? That's difficult to answer because management does not provide forward guidance, which limits our ability to model or predict a clear turnaround timeline. What we know is this: Tata Technology is a fundamentally strong business operating in a structurally relevant space. Over a full cycle, growth should come back. The only question is when, and that is the most important thing investors need to understand. So at current level, Tata Technology is not an obvious bargain, but it is also not a broken story. It's a patience test. Returns will depend less on valuation re-rating and more on actual earning recovery. So for now, Tata Technology is part of my close watch list and tracking it very closely. As far as smart money flow is concerned, institutions have shown some interest in the last few quarters and public holding has consistently reduced. So that is also a positive sign. Technically, share price is still in constant downtrend and trading below its 50 and 200-day moving average. Overall, if we conclude, Tata Technology is not a broken business. In fact, it operates in a very exciting space. Engineering complexity in auto is increasing, outsourcing is a long-term trend, and OEMs will continue to need specialized ER&D partners. From that lens, the long-term demand story remains intact. What has changed is the expectation. The stock listed in a very overheated phase, valuations ran far ahead of fundamentals, and earning growth failed to keep up. That mismatch is what caused the long correction. And even today, while valuations have cooled off meaningfully, they are not cheap enough to ignore weak near-term growth. Although from here the downside looks relatively protected because of a strong balance sheet, then Tata Group credibility and structural relevance. But upside will only open up when the earning growth actually comes back on track. So for now, this has been set as a watchlist candidate, not a blind bet. If growth revives, there's meaningful upside from here. If it takes longer, returns will test patience. That's the trade-off. And that's exactly where contra investing comes in. Not buying what looks perfect, but understanding what the market is currently disappointed about and deciding whether that disappointment is temporary or permanent. Well, let me not stress this video further. If you find it useful, do share it within your circle. Also, let me know what is your take on Tata Technology. I'll see you next video. Till then, take care.